question right to you. I mean, it's great to see a stronger than expected jobs report that more Americans are getting back to work in this economy, more signs that a recovery is starting to take root on the one hand. On the other hand, you've got all those concerns in the market that we could potentially see, an unleashing of demand much faster and more furiously than I think has been expected, what that's going to mean in terms of the inflation picture, Fed policy, et cetera. So why, and I realize that we are off the highs of the morning and the NASDAQ is actually negative, but when you look at the S&P or the Dow, why are we trading higher today?
Well, I think this is good for value stocks. I mean, I do think we're seeing a strong cyclical upturn in the economy here. What's going on is we've adapted to the pandemic quite well. The economy is doing okay. And now we've got policy is kind of like the accelerator is welded to the floor here. We've got this huge stimulus bill. It looks like it's going to go through the Senate with not much modification from the House version. So about $1.8 trillion of stimulus, about $1.2 trillion of that hitting in the next 7 months. That is enormous. And we've got the Federal Reserve basically committed to keeping rates low and keeping bond buying going, even if we get a transitory surge in inflation. So I do see we're building to a lot of growth, a lot of inflation as this year goes on. But that's not bad for value stocks, which are sitting at low levels. It's not bad if you want a steeper yield curve. It just does threaten growth stocks. It threatens high PE stocks. And I think that's what we're seeing in markets.
Yeah. Megan, I want to get your thoughts on this. Not only the, trading action today specifically, but also, you still have a 10-year at 1.573% right now. If you expect we're going to stay at this higher level, I realize we're still at historical lows, but higher level versus just a week or a couple weeks ago, or you expect that we're going to continue to creep higher in yields, how do you play that as an investor? How do you assess your portfolio right now? What would you be buying or selling?
Yeah, Morgan, great questions. So I would say in terms of what we're seeing today in the price action, I do think the bond market and the rate market has gone ahead and priced in a few more of these really good reports. It is consensus for us to have a very strong year of economic recovery. We do very much think we're at an inflection point. For reference, we need to see, if we saw 500,000 net new jobs every month, it would still take us until the fourth quarter of 2022 to get back to where we were. So we're still digging out of a very deep hole. Our expectation is for interest rates to move higher over the next year, probably approaching 2%, actually, in that 1.75 to 2% range. I do think it matters how fast you get there. And I think we've had quite an aggressive move. We don't expect that speed to continue. But we see that interest rate backdrop as coming alongside a very constructive economic environment. So from a portfolio perspective, we've been adding to cyclicals. We are overweight to financials, energy, materials, industrials, those sectors that are really tied to the health of the economy and rely on economic growth for their earnings potential. When it comes to tech and growth stocks, though, we are still neutral. We are not selling. I think when you're a tech investor and you're talking about this secular growth shift and these multi-year trends, you really do need to take a multi-year investment outlook. And so we're looking at rate-driven volatility in some of these big platform tech names, some of the FANG names, as potential buying opportunities.
Shepard Smith here. Thanks for watching CNBC on YouTube.